The smart money is moving to the blockchain, and it's not for crypto, it's for maritime insurance. Institutional risk is being re-engineered into decentralized pools that remove human error and bias from the claims process. This is the definitive signal that the era of legacy financial gatekeepers is officially coming to an end. For over 300 years, the global shipping industry relied on a single room in London to decide if its ships could sail. But right now, beneath the surface of the daily geopolitical noise, a silent trillions of dollars migration is taking place. The ships that carry 90% of global trade are no longer waiting for traditional syndicates to process their claims. They are routing their risk directly into automated, uncancelable, decentralized software pools. You are watching the Signal and Noise podcast. My name is Newell. Take a moment to like and subscribe. Make sure to watch till the end to catch the ultimate signal. Let's look at the raw mechanics of the new global trade armor. Let's talk about Lloyd's of London. For 3 centuries, this institution has been the undisputed apex predator of international shipping security. It survived the world wars, the transition from sail to steam, and the birth of containerization. The system worked on a remarkably old-school framework: discretionary syndicates, signature stamps, and gentlemen's agreements. If your fleet hit a massive storm, you filed a mountain of paperwork. A human broker argued with a human underwriter, and months, sometimes years later, capital eventually trickled down to fix your ship. But as we navigate the volatile supply chain landscape of 2026, that 300-year monopoly is completely fracturing. Modern global logistics cannot survive on historical prestige. Black swan events, rapid drone lane rerouting, and massive climate anomalies require instantaneous adaptability. In a world where a supply chain bottleneck costs millions of dollars per hour, waiting weeks for a London committee to sit down in a wood-paneled room and manually evaluate a claim is no longer just a slow process. It is a fatal operational risk. The old discretionary model is structurally disintegrating under the sheer speed of modern commerce. Look at the stark reality of how trade actually moves today compared to the legacy system. We are rapidly entering the era of fully autonomous shipping corridors. Unmanned megaships routed by machine learning arrays, navigating precision deep water lanes. These ships operate on data streams refreshed every microsecond. They optimize their fuel, speed, and positioning automatically based on satellite data feeds. Yet if one of these modern marvels suffers a mechanical failure or hits an unexpected ice sheet, the legacy insurance framework demands that the operation grinds to a halt to accommodate manual paperwork. You have to call loss adjusters, fly inspectors out to remote ports, verify paper logbooks, and wait for legacy banking networks to clear settlement funds during regional business hours. It is an absurd, painful mismatch of technologies. High-velocity, autonomous shipping corridors require high-velocity capital. You cannot run a 2026 automated fleet on 18th century administrative speed. This operational friction brings us to a major point of failure: the classic gentleman's agreement. Historically, maritime underwriting was built entirely on discretionary trust. The underwriter looked at the shipowner's track record, shook hands, and signed a slip. If a loss occurred under ambiguous circumstances, the payout was frequently a matter of negotiation, litigation, and political leverage. In the era of instant data and algorithmic certainty, that entire model falls apart. Why leave a multi-million-dollar claim to human bias and arbitrary interpretation when the entire voyage is continuously logged by thousands of verified hardware sensors? Discretionary trust is an incredibly inefficient way to price risk. The market is realizing that math doesn't have bad days, math doesn't get political, and math doesn't try to find fine print loopholes to avoid a payout. The industry is rapidly abandoning human bias in favor of absolute cryptographic certainty. Let's look under the hood at how this actually works right now. This isn't conceptual. This is the live 2026 liquidity layer. Instead of capital being locked up in traditional, opaque institutional bank accounts owned by legacy syndicates, global capital flows directly into on-chain programmable risk pools. Institutional investors, hedge funds, and sovereign entities pool their capital digitally to underwrite hull and cargo risk. These pools are entirely dynamic. Capital providers can instantly read the exact risk profile, the historical loss metrics, and the current exposure of the entire pool directly on the ledger. The capital sits ready, completely liquid and unencumbered, wrapped in specialized smart contracts. Because the system doesn't require massive central office skyscrapers, armies of compliance managers, or administrative middlemen, the cost of matching capital to risk drops to near zero. It turns the underwriting of global trade into an efficient, real-time open marketplace. The real magic occurs the exact moment a loss happens. In the traditional world, if a cargo container gets ruined due to a refrigeration failure, you enter a months-long bureaucratic nightmare with a loss adjuster. On-chain risk pools utilize parametric smart contracts. The insurance policy is written completely as code, tied directly to verified tamper-proof Internet of Things, IoT sensors installed on the ships and cargo containers. If a container's internal temperature spikes above a hard-coded threshold for more than 6 consecutive hours while transiting the tropics, the contract executes automatically. The IoT data feeds the ledger via decentralized Oracle networks. The smart contract instantly verifies the data breach and triggers the payout immediately. No claims forms, no phone calls, no months of waiting for an adjuster to verify the damage. The capital is routed to the shipowner's wallet before the vessel even docks at its destination port. Think about the astronomical overhead built into the legacy system. The traditional insurance stack is bloated with layers of retail brokers, wholesale brokers, reinsurers, and administrative clearers, each taking a massive cut of the premium just to pass data back and forth. Replacing that middleman matrix with automated risk modeling protocols strips away up to 40% of the structural overhead. The software automatically handles the risk calculation, matches the premium to the liquidity pool, and logs the coverage state. This massive cost reduction has completely democratized access to the market. Emerging market fleets and smaller independent operators, who were historically locked out or priced out by Western financial gatekeepers, can now access top-tier institutional-grade coverage instantly. They simply plug their fleet data into the protocol and receive competitive, algorithmic rates entirely independent of their geographic location or political standing. But let's look at the actual settlement medium, because this is where the geopolitical noise gets totally silenced. Traditional cross-border claims payouts are completely tethered to correspondent banking networks like SWIFT. If a ship undergoes a loss in an emerging market, routing a multi-million-dollar wire transfer can take days, encountering friction from regional capital controls, bank holidays, and shifting sanctions frameworks. On-chain risk pools settle exclusively via stablecoin indemnity. When a parametric trigger fires, the settlement capital moves instantly across the blockchain infrastructure in asset-backed digital dollars or euros. It completely bypasses traditional banking friction and sanctions-related settlement delays. This infrastructure has become so dominant that we've witnessed a massive regulatory shift. Major global port authorities, including Singapore and Rotterdam, officially recognize on-chain proofs of coverage as legal tender for port entry and maritime clearance. If your digital wallet proves the smart contract is active and funded, the port gate opens. Period. The code has become the law of the sea. Let's look at the absolute transparency shift. Traditional underwriting is a notorious black box. You can't see their real-time books. You only see their quarterly marketing reports. Tokenized risk pools operate inside a financial glass room. Because every single premium payment, every digital twin asset, and every liquidity deposit is logged transparently on networks like Ethereum and Solana, any investor or ship owner can audit the precise, real-time solvency of the pool with a single click. Any investor or ship owner can audit the precise, real-time solvency of the pool with a single click. Logistics giants are recognizing this immense capital efficiency. Instead of running expensive, opaque, captive insurance divisions in offshore tax havens, they are migrating their entire risk apparatus directly onto open blockchains. They can deploy capital perfectly, maximize yield on their reserves, and guarantee instant payouts without maintaining massive corporate cross-holdings. When we look at the long-term horizon, we are moving toward a reality where maritime trade is protected by global, decentralized software rather than national interests. Historically, naval power and national insurance syndicates were used as geopolitical levers to cut off rival nations from trade. If a Western institution canceled your fleet's insurance, your ships were effectively grounded worldwide. Decentralized on-chain pools decouple international trade from national warfare. The software operates as a completely neutral global utility. And as we look forward, the convergence of AI-driven autonomous navigation and parametric on-chain insurance will give birth to the first fully self-insuring trade routes. Autonomous fleets will stream their operational, safety, and maintenance data directly to underwriting protocols in real time. If the AI pilots the ship flawlessly through a treacherous strait, the premium rates drop dynamically second by second. The ship literally funds its own indemnity through its operational perfection, completely independent of human intervention. The transition we are witnessing right now is the final nail in the coffin for centralized financial monopolies in the shipping industry. The old 300-year-old rooms are growing quiet, not because the ocean got safer, but because the world found a better way to handle risk. You can listen to the noise that says legacy institutions will control global trade forever. Or you can look at the signal. The physical lifelines of global commerce are rapidly uploading their security into the unchangeable architecture of the blockchain. The valves are active, the software is deployed, and the old gatekeepers are officially out of time. The signal is the programmable certainty of risk. The noise is everything else. If this breakdown brought you value, make sure you slam that subscribe button, hit the like, and drop your thoughts in the comments below. How long do you think legacy underwriting houses can survive before they are completely forced onto the ledger? Let's get into it in the comments section. What would you like me to discuss next? Do you want me to dive into the hidden regulatory threat to legacy cold storage security? Or maybe talk about the geopolitical race to control global liquidity through programmable money? Until next time, stay analytical, focus on the signal, and ignore the noise.